So earlier this week, I was scrolling through YouTube and I happened up on this in my recommended feed. So the video showed how Dave Ramsey, quote, eviscerated his co-host George Kamel for preaching the 4% rule, which is the idea that you can take out 4% of your nest egg in retirement and still have that nest egg last for 30 years. In the video, Dave asks what George Kamel was thinking by going with the 4% rule and preaching that on his channel. And he says he's going to go and find the video and get it taken down because you can take more than 4% out every year and be safe. Dave says that the safe withdrawal rate should be not 4%, but get this, 8%. So what this video is going to do is look at what he actually said and then analyze whether or not that would work in the real world and whether you'll be having a great retirement or whether you might be trying to figure out, 72 ways to eat Alpo and enjoy it.
Well, there's a lot of studies that are stupid in this space. It's just wrong. Listen, man, the math I just gave you is the math. If you're making 12%, and inflation is 4, and you leave 4 in there, so your nest egg grows by 4. It's simple. 8 is what's left over. So if you got $1 million and you leave 4% in there, that's $40,000 bucks. Okay, so you now have $1,040,000. So the next year you get a rate of return of 12%, 11.5% on the $1,040,000, and the next year it'll be $1,090,000, 1.1, right? And so your nest egg is growing by the rate of inflation, giving you a cost of living raise every year. So as long as you're doing that, you're fine.
So what Dave appears to be saying is that you should be able to take out $80,000 every year in perpetuity if you have $1 million in the bank when you retire. Now, that's all well and good if the stock market actually returned that 11.8 to 12% every single year. That's just a long-term average. There are years when the market goes down a lot. There are years when the market goes up. To show you what I'm talking about, I've gone to this Macro Trends website and looked at the S&P 500's historical annual returns. So if we scroll down, you can see this chart that looks at all years, all the way back to the 1920s, the Great Depression. And it shows that most years you're going to have the stock market in the green. Some years, however, you're going to see the market in the red. Now, if that's just one year, that can be overcome, but sometimes you'll have what's called the sequence of returns risk. And that's when you retire, you have a certain amount of money, and then the market decides to go down immediately so that you're not only taking out the money that you need for that year, you're also going to get hit by the drop in the price of the stocks. Now, I've gone down here and I've put up 1997 to 2009. And I want to draw your attention especially to what's called the lost decade. And that would be 2000 to 2009. So January 1st, 2000 to December 31st, 2009. And if we look at that right off the bat, you have 3 straight years where you're losing money. And I want to go in here now and show you what might have happened had you decided to take out $80,000 on an annual basis without factoring in inflation. If you decided to just take out 8% a year, and then we'll look at the 4% rule, and you can make up your own mind as to which is a better idea for you. So if you're finding the content educational, now would be a great time to just drop us a like. And also, if you've not already done so, give us a subscribe. So thanks a lot. The channel appreciates it. I appreciate it. And the world will appreciate it when this great content gets out to more people. It would be a good idea to make up a few Excel spreadsheets. The first one is going to go with just the straight $80,000 withdrawal every year on January the 1st. And then over the course of the year, you take out if there is a decline in the stock market, or you add money if there is an increase in the stock market over that time. And I looked at 2000 through 2009 and taken $80,000 out every year. And if we look at that, Over the first 3 years, it's down 10, 13, and 23%. So your $1 million balance over those 3 years has dropped to $436,000 with taking $80,000 a year out. Now it starts to recover from there. You go up 26%, you go up 9%, roughly 3%. Note that none of these years are 12% like Dave says you're going to get. If you go to 2008, that's when the economy totally went down the toilet and you had the Great Recession. You dropped 38.49% that year, which dropped you to $83,370. And then you'd take out your $80,000 and you leave in 2009, even though there's a 23% return because your actual balance is so low, you're down to $4,600 at the end of the year. And that's all you can take out at the beginning of 2010. One of the reasons that Dave said he didn't like the 4% rule was because it takes people's hope away, the hope that they can achieve retirement at a good standard of living. Well, if we take out $80,000 a year and in those 10 years they replicate 2000 to 2009, you better have a little bit of hope. That hope is that you can find a job, whether that's a Walmart greeter, whether that is pushing carts at your local grocery store or something of that nature. So that brings us to chart number 2 in our really fun Excel spreadsheet. I know they're all the rage and you're really excited to look at it. But anyway, you'll note the returns are exactly the same. The starting balance of $1 million is the same. The first year's $80,000 withdrawal is the same. And then after that, we just take out 8% per year of whatever the ending balance was. And then it either goes up during the year or goes down based upon the actual return that the stock market gives. Now, if we look at this, after the Great Recession starts to turn around and the stock market starts to go back up in 2009, you actually are down only to $329,000 rather than the $4,000 we had in the previous example. So this is a little bit better, but your withdrawal and your standard of living has dropped from $80,000 at the beginning, and then by taking out 8% of $290,000 at the beginning of 2009, your withdrawal is down to $23,219. That is a real haircut, but it's something that you would need to be aware of if you decided that an 8% return is, or an 8% withdrawal rate is safe for you. The sequence of return risk is real. And to show you how real it is, if you remember what we had in the last sheet of the spreadsheet, I've just added 3 years prior to 2000 to this one. And in those years, you had 31, nearly 27, and nearly 20% returns successively. If you go back 2 more years, you could actually see that the stock market went up a lot those 2 years as well. But I would just wanted to start out and show you how, with a beginning balance of $1 million and then a withdrawal rate of 8%, what that's going to look like if you start under better economic conditions where the market's going up. So if we look at that, you actually finish 2009 with nearly $600,000 left, taking out 8%. Your withdrawal has actually dropped in about half, from $80,000 the first year, and it actually reaches $145,000 in 2000 because you're up to 1.8 million because your growth has actually exceeded what you have taken out. And that actually plays out like Dave expected, but then you hit a market crash in 2000 to 2002, the dot-com bubble. But still, it shows the sequence of return risk is real, because if you have up years early in your retirement, that can offset bad years later on. Now I want to start and look at a couple of scenarios in which we don't have an 8% withdrawal rate, but rather a 4% withdrawal rate. And it's not stagnant. It's based upon the balance in your account at the end of the year. And the first sheet I'm going to look at in this wonderful spreadsheet is 2000 to 2009, we have the 3 down years at the beginning, then 4 or 5 up years, and then another really bad down year in 2008 before the market recovers. So with a 4% withdrawal rate, we start out with a $40,000 withdrawal the first year. And by the end of 2002, our $1 million has dropped to $529,783. So then it starts to go up from there. And by 2007, you're at $720,000 before the big crash in the Great Recession. And your withdrawal rate has dropped between 2000 and 2009 from $40,000 to $17,028. However, you still have an ending balance. Even after all of that, with a bad sequence of returns, you still have over $500,000, $500,000. Not a great way to have a high standard of living, but it's a heck of a lot better than having nothing left after 10 years. And that's a big difference between 8% withdrawals every year or 4%. So now for the 5th scenario in our little spreadsheet. And for this, I've started at 1997 rather than 2000 to show the importance of the sequence of returns, with an up market to start with before the market crashes, then recovers, then crashes, and then starts back on an ascent. Right. So the beginning balance is still $1 million. The withdrawal is still 4% or $40,000. And then it goes up to $1.9 million by the time you hit January 1st, 2000, before the dot-com crash. And even after that, you still have $1 million left. So you've actually seen your money grow, and your withdrawal rate has gone up, or at least the dollars that you're withdrawing each year have gone up. And they don't go down until the Great Recession. And even at that, they go down by like 20% from what they were at the peak, rather than more than 50% under the other negative sequence of returns. And even after all of this, the lowest your balance is going to go with a 4% withdrawal rate is going to be $809,000. And by 2009, when the market starts going back up, you're almost where you started out. You have $959,000, which is a $41,000 drop from the $1 million that you started with. Plus, you've taken out at least $40,000 every year, with the exception of 2009. So it shows 4% rule is a lot safer. Plus, the sequence of returns risk is a very real thing that you need to pay attention to. I'm not a financial advisor, but this is just for educational purposes and to show you what's happened in the past. What happens in the future may be totally different, but it's likely that a 4% withdrawal rate is going to be safer than definitely an 8% withdrawal rate. There are some studies that show if you start right at the beginning of a bull market, like in 1995, when the big market run up is going up with the tech revolution and all that kind of thing, you could have retired then and probably been safe with a 5, 6, and some points in history, you could have retired with a 7 or 8% safe withdrawal rate, but you just never know. And it's better to be safe than to be sorry, aka reading and trying to figure out 72 ways to eat Alpo and love it. I also want to say that I dig a lot of what Dave Ramsey says. I like what he says about debt. I like what he says about needing to save at least 15% for retirement and things like that. However, the 8% withdrawal rate is make that a lot bit risky, and that's why I made this video. So hopefully it can show you what the issue is with an 8% withdrawal rate. I also use the S&P 500 exclusively. Dave Ramsey recommends splitting your retirement dollars into 4 different buckets. I didn't do that for the sake of simplicity. I just stuck with the S&P 500 because that is the leading indicator on the U.S. stock market on average. So again, I hope that you have found the video informational. If so, would you be so kind as to just drop us a like, and then also subscribe, also share, also watch more of our videos. It would be greatly appreciated. Thanks again for watching, and until next time, have a great day.